In this lesson, I'm going to talk a little bit more about gross income. I'm going to also talk about deductions for adjusted gross income, the concept of adjusted gross income, standard deduction or itemized deductions, and then the concept of exemptions, and then finally our gross tax liability. All right, so first I want to talk about gross income. Gross income, this is the starting point. This is where everything begins with your taxes. So gross income includes all income unless the tax law provides for a specific exclusion. So gross income is all income unless specifically excluded. This is everything. All right, this is going to be dividends, pensions, Social Security, capital gains and losses. Dividends, I think I already said that. If you receive it, it's likely taxable. All right, so this is going to be your top number in that equation we just talked about in the last lesson, which was the tax formula for individuals. Gross income is that top line number. Next, I want to talk about the deductions for adjusted gross income. So deductions for adjusted gross income, these are what we call above the line adjustments, or deductions rather. So deductions for, all right, so this word right here, for, is very important. Deductions for AGI. All right, so this is our first category of deductions. These are usually certain trade or business expenses. Sometimes you get certain reimbursed employee expenses. Pre-2019 alimony payments. 2019 alimony. Certain business. All right. Student loan interest deduction. This is where this comes out. This is a good one. I'm sure we can all commiserate on this one. Student loan interest. The penalty for an early withdrawal from savings, contributions to a qualified retirement plan, and certain educator expenses. These are going to be your deductions for AGI. Next, we move into adjusted gross income. So after you've taken your gross income, which remember is your total income unless specifically excluded, minus your deductions for AGI, you arrive at, I'm going to go ahead and drop a line here, we'll just put this bar here to assume that we've taken our gross income, 1, and then we've subtracted the deductions for AGI. So look at it that way. Put a set of parentheses here so that you know that this is subtracted. And then this makes us arrive at adjusted gross income. All right, so you're following. Adjusted gross income is the amount that is usually referred to as the magic line. It is the basis for a lot of deduction limitations, phase outs, medical expense deductions. It also determines your charitable contributions, etc. Adjusted gross income is an important number. All right, so I'm going to put a little star here. This number here is going to be talked about a ton this semester. After we've gotten our adjusted gross income, we're going to talk about the concept of standard deduction or itemized deduction. All right, so first, let me get us another page here. The standard deduction or itemized deduction. All right, so this is a topic of conversation that comes up a lot around tax time. So we have the standard deduction versus itemized deduction. All right, so in short, you should, and I'm going to put should capitalized, you should take the higher of the two. Should, okay? Should statements, sometimes life doesn't work out that way. We'll get into instances where you may not be able to take the higher of the two, and boy, is it a bummer. All right, so itemized deductions are certain personal expense items that Congress allows taxpayers to take as tax deductions. We're talking things like interest expense, mortgage interest expense, state and local taxes. Sorry, I did not mean to scroll up like that. State and local taxes. For now, this is capped at 10,000, by the way. Fun little fact. That hurt a lot of people. And there's some other miscellaneous items that we really will dig into the details of later in this chapter. I'm sorry, book rather. All right, taxpayers should only itemize if their deductions exceed their standard deduction amount. So the standard deduction, that's the amount that you get if you don't have items to itemize. So let's say you don't have a home, you don't have state and local taxes. Every taxpayer gets a standard deduction, and it's earmarked for inflation. So for the tax year 2021, so the 2021 tax year, an individual, a single individual filing a 1040 got $12,550 for their standard deduction. A married filing joint, so this is going to be single. This is married filing joint, MFJ. They receive double this, $25,100. Married filing separately, they also get this. So this is married filing separate and single. If you are head of household gets $18,800. And lastly, qualifying widower also falls into the married filing joint category. All right. So for now, that's what we need to know. Now there are situations where you get an extra additional standard deduction. So we'll call this additional standard deduction. And that is going to be if you are 65 or older, and or blind. You can get both. So if you are 65 and blind, you will get both. You will get an additional standard deduction for both. And for 2021, the additional standard deduction amount is $1,700 for a single taxpayer and $1,350 for married taxpayers and surviving spouses. What that means is if you're a married couple and you're both over 65, you would take $1,350 times 2, and you would arrive at $2,700. Take the same situation here. This is a married filing joint. If you take a single person, they would get that $1,700 times 1, because there's just one of them, and then they would be looking at a $1,700 additional. In this particular case, if these taxpayers were both also blind, then it would be $1,350 times 4, or otherwise $2,700 times 2, which is, I believe, $5,400. So in this case, it would be $5,400 if they were over 65 and blind, both. If one is over 65 and the other is not, then you just take that $1,350. Remember, if they're married filing joint, it's the $1,350, not the $1,700. So a single person is going to be $1,700. If this person is 65 and blind, it would be $1,700 times 2, because remember, 65 and blind would equal an additional standard deduction, $3,400. So that goes right on top of, for this person, would be $12,550 plus $3,400. So that number would be what they would report on their taxes. So the Tax Cut and Jobs Act eliminate it. No more exemptions. Now, they'll come back, I'm sure. But some of you have been filing taxes for many years. Remember, you got an exemption for each kid, you got an exemption for yourself, for your spouse, etc. Instead, the standard deduction has increased quite a bit. So as of this point, there are no exemptions. And lastly, in this part of this equation, after we subtract it, so we start at the top again, gross income minus our deductions for adjusted gross income equals our adjusted gross income. Then we subtract out the higher of standard versus itemized deductions, and we arrive at a place called gross tax liability, and this is derived by taking these numbers, subtracting all of the things that you're entitled to, and then multiplying by tax rate in the you would be given a tax table in this class, but there are other ways to derive those tax liabilities. And then you pay that, and you are done. And that is pretty much it with this lesson.